Most people think they understand what the Federal Reserve is doing right now. They think the Fed is still fighting inflation. They think interest rates will stay higher for longer. They think waiting for clarity is the smart move. But history shows something very uncomfortable. By the time the Fed admits it's changing direction, the opportunity is already gone. And when you strip away the headlines and actually look at the data, a very different story starts to emerge. A story that suggests rate cuts are closer than most analysts are willing to admit, and that smart money is already positioning for it. Welcome back to Safe and Average Finance, where we focus on realistic, long-term money strategies instead of hype and fear. If you're newer to investing, this video may challenge what you've been told about interest rates and waiting for confirmation. The Federal Reserve officially has two jobs: control inflation, which is a target of about 2% per year, and support employment and economic growth, which means reducing unemployment to as much as we possibly can without it being unrealistic. Most beginners assume these are equally weighted. Well, they're not. The Fed treats this mandate like a sliding scale. Whichever risk threatens the system more becomes the priority. In periods of high inflation, growth becomes secondary. In periods of weakening growth, inflation becomes manageable. This is not hypocrisy, it's risk management. In 2022 and 2023, inflation was rising fast enough to threaten long-term stability, so the Fed tightened aggressively, even knowing it would slow the economy. But early 2026 looks very different. Inflation has cooled from its peaks. It's not perfect, but it's no longer spiraling, and that gives the Fed room to refocus. The new risk isn't runaway prices, it's economic momentum quietly stalling. One of the biggest misunderstandings new investors have is how delayed monetary policy really is. Interest rate hikes don't hit the economy instantly. They move slowly, sometimes painfully. Businesses don't fire workers the moment the rates rise. Consumers don't stop spending overnight, and banks don't pull credit immediately. Instead, pressure builds quietly. You see it in a slower job creation and not in mass layoffs, fewer new business investments, consumers relying more on credit instead of income, and lenders tightening standards behind the scenes. These are early warning signs, but not breaking news. By the time unemployment spikes, the damage is already done. The Fed knows this. That's why they don't wait for economic pain to be obvious. They try, sometimes imperfectly, to act before it becomes irreversible. Higher for longer makes a great headline. It sounds decisive. It sounds tough. It sounds reassuring. But it's also incredibly misleading. Historically, interest rates rarely stay at restrictive levels for long periods without something breaking. High rates increase government debt and servicing costs, corporate refinancing risk, consumer credit stress, and finally, system fragility. At some point, maintaining high rates becomes more dangerous than cutting them, and that's the moment the narrative flips. The Fed doesn't cut because inflation is won. They cut because the cost of holding rates high becomes unacceptable. That moment usually arrives sooner than the public expects. Here's a critical lesson for new investors. Markets don't wait for Fed announcements. They move in anticipation. Bond markets especially are brutally honest. When investors believe rate cuts are coming, long-term yields fall first. Bond prices rise, and risk assets quietly reposition. I've seen this multiple times before as we focus on what the Fed is doing, and there might be an interest rate cut. If it is exactly what people expected, the market doesn't change. It was already priced in. By the time the Fed confirms a pivot, the easy gains are already gone. That's why waiting for clarity often leads to underperformance. Clarity arrives late. Right now, many investors are obsessed with short-term yields. They see attractive rates and assume that staying flexible is safer. Smart money thinks differently. Instead of chasing yield, they focus on locking it in. Long-term, fixed income assets provide something most people underestimate: stability, predictability, and upside when rates fall. When volatility increases, certainty becomes valuable. This isn't about predicting exact dates. It's about understanding incentives and direction. And the direction is shifting. If you're early in your investing journey, here's what matters most. You don't need complex strategies. You don't need perfect timing. You don't need insider information. You need patience, discipline, and an understanding that markets move before consensus forms. The biggest mistake is waiting until everyone agrees, because by then, the opportunity has already passed. If you want to know more about finance and these different topics, I write articles on saf-finance.com. If this helped you see the Fed differently, consider subscribing. Stay safe, stay average, and don't fall for the rate hype. It's not worth it. You don't need to take it.